Um, Thank you everyone for attending the conference. Can I see the attendees? Okay,
Yeah, let them
so
come in first. Yeah.
we are waiting for everyone to join. So just give it a few moments. Okay, we'll start. Thank you everyone for attending the conference this afternoon. My name is Jennifer and I'll be your moderator for this session. A few housekeeping points, 2 points that I would like to brief on. There will be a Q&A chat window at the bottom of the screen. You can use that to post questions that you have during the presentation. There will be a panel discussion at the end of the presentation, and Q&A questions will also be raised during the Q&A session. The next point is on the polling questions. Before we begin, I will start the first set of the polling questions. So please take your time to answer, and the results will be shared before the panel discussion. And there will be a second set of polling questions that will also be released before the panel discussions to facilitate the panel discussion. So let me share the first set of polling questions. Okay, do take your time to answer, and I will do the introduction. So moving on, the topic that we're talking about today is cyber reinsurance and ILS. We are very honored today to invite experts in this area of interest that are currently picking up in this region. The Singapore Actuarial Society have an ongoing cyber and emerging working party, which has been sharing interest in this area for a few years now. Thank you to them for making this session possible today. We are delighted to have Siliang Lau to join us in this session. Siliang is the head of the Lloyd's Capital Provision and Cyber of UK and London market in SCOR since April 2019. Siliang has over 20 years of diverse experience. Prior to relocating to the UK office, Siliang has been the chief actuary for SCOR Singapore for about 8 years, responsible for statutory reporting, capital management, and reinsurance optimization. Siliang is now based in SCOR, UK, and has plenty of experience to share with us today. Our second speaker today is Paul Wee. Paul is a corporate actuary with Swiss Re since early 2019, where he's in charge of reserving, reporting for Swiss Re Asia entity. He's currently the appointed actuary for Swiss Re Malaysia. Paul has 17 years of experience in reserving, treaty pricing, and risk management in the region. Paul is also currently the chair of the SAS ERM committee, which supports the emerging risk, climate risk, and AI modeling working parties. He's also the volunteer with IFOA Cyber Risk Investigation and the GI Asia working groups. Our final panelist today is Linda Siu. Linda is an independent consultant with a wide range of experience in pricing, reserving, risk modeling, and underwriting. In the recent few years, Linda has been specializing in the pricing of innovative products such as new mobility, car sharing services, cyber risk, and pandemic business interruption. Linda is also the pricing actuary of MAS-sponsored Cyber Risk Management Project and active member of the Emerging Risk Working Party. Without further delay, let us welcome our speaker and panelists to begin the conference today. Siliang and Paul will commence the presentation. Thank you. Siliang, I pass that to you.
Thank you, Jen. Good afternoon, everyone, and thanks for attending this webinar. I hope you will find the session interesting, and amid the COVID-19 context, I believe it's paramount to look into cyber risk even more closely as a profession. So as we all know, the cyber insurance market is ever evolving compared to back in 2010, when the coverages for standalone cyber product were still pretty restricted to data breach and was quite expensive then. To now, the coverages are very broad and definitely more affordable than before. And the primary sector has grown considerably in the last 5 years, definitely in the US and in Europe. And now we're also seeing in places like in APAC. And the demand for reinsurance has also picked up correspondingly, especially when the aggregation systemic nature of cyber risk is a concern, not just to the board members of the business, it's also a concern of many regulators. Equally, with the rise in demand, especially for large corporate risks, the capacity for such demand has risen, however, not proportionate to the level of the rise in needs and demands for such protection. There are also definitely more push for clarification by regulators, such as in the UK in January 2019, the Prudential Regulatory Authority, or PRA, instructed insurers to have action plans to reduce the unintended exposure that can be caused by non-affirmative cyber cover. And also in July 2019, as well as in January 2020, Lloyd's of London has issued two market bulletins, Y5 25A and Y5 277, respectively, basically require all policies, all insurance policy be clear on coverage for losses caused by a cyber event, either providing affirmative coverage or excluding coverage in phase implementation across all classes. And equally, rating agencies such as Fitch have cited failure to manage non-affirmative cyber risk and exposure are becoming the ratings criteria. And finally, all mainstream modeling vendors, with the infamous RMS, AIR, as well as some cyber specialists such as CyberCube, Science, FICO, COA, Corax, are all racing to roll out models that are actually going to be able to reflect better the nature of the cyber risk, and also in terms of the accumulation scenarios, and also as stochastic as possible. Okay, even then, this model are still very early in terms of finding the best way to reflect the systemic nature of the cyber events. So based on all this quick executive summary, here are pretty much the agenda for today. Essentially, we will take us, this agenda will take us through, set out on the screen here, the next about 30 to 35 minutes on the topic of the state of the reinsurance and insurance market, some high profile losses, and we'll touch on COVID-19 as well, amid where we are at the moment. And we will also touch on IRS instruments and also some concluding thoughts to share with you all. Paul essentially will take over from IRS instruments part 4 onwards. Okay, so what I'm trying to show you now is some figures. Because this is not a live conference, not in person, so I can't really ask you to guess the numbers on the screen. So basically, I just wanted to basically show that the numbers are, there are 3 sets, for one set expected for 2020 and another set projected for 2025. And bearing in mind, these numbers are before the effect of COVID-19. So I can confirm the first set of the numbers are estimated global GDP for 2020 and 2025. I mean, the first step what I meant by is this 90 trillion and the 104 trillion. So with the second set, on this 2.5 trillion being the premium for global non-life, and the last set, 6 billion, guess what? I mean, this is essentially the topic of what we're talking about today, the standalone cyber insurance market premium that estimated to be reaching at the level this year. And in terms of the GDP, this is before the COVID-19 impact. So I have used 3% per annum growth per year to project the future GDP expected of by 2025. The purpose of doing so, you see in the next slide, is really to showcase what is the penetration rate in terms of the non-life premium to the GDP and what it means in terms of the growth of the cyber insurance premium. And when we talk about cyber insurance premium, here we are actually touching on the standalone cyber insurance product rather than the one with this with the so-called silent, the non-affirmed or non-price cyber extension part of the perils of other traditional insurance policy, for instance. So we can see the global GDP is expected to hit USD 90 trillion. And even this is an assumption before the COVID-19, and we will leave it as an assumption for the purpose of this illustration. But just bear in mind that if there is any indication what the COVID-19 effect would have on the global GDP, it will set us back by at least 2 years. So what I'm saying here, this 2020 90 trillion may become, we may only get this by 2022 maybe, and this 2025, in terms of the projected GDP, we would expect this maybe in 2027 instead, but still early days. So by sticking to the same assumptions, you will see the non-life global insurance premium is expected to hit USD 2.5 trillion in 2020, which is about 2.8% of the penetration. And the global cyber insurance premium, on the other hand, is expected to hit 6 billion, but it's only 0.25% share of the non-life premium. So you can see how tiny this is as a fraction of the non-life sector. Assuming the growth rate of 3%, as mentioned before, per annum for the global GDP, the GDP by 2025 will be expected to be 104 trillion. And assuming the same penetration rate to the GDP of 2.8% for the non-life premium, it will give us only roughly about 2.9 trillion. Still very tiny in terms of growth, but we have seen the standalone cyber market growth in the last few years, averaging around 20-25% per annum. So if we have that growth rate to continue for the next 5 years, it will actually easily hit 18 billion by 2025. On this actually basis, we can tell the share of wallet in terms of non-life premium will quickly increase from 0.25 to 0.65%, which is quite a growth actually. In terms of the speed of growth, we're talking about definitely over 2 times faster than the traditional non-life premium. Well, could it be more, or would it stay roughly flat? We don't know, because with now the ongoing pandemic crisis, the estimate may be totally out of the window, and only time will tell. Nevertheless, this is a good proxy to show that the momentum for the growth in the standalone cyber insurance market has definitely picked up and can only grow faster as we are ever more connected and digitalized. And I predict the market being dominated by the commercial world will also be shifted to more personal lines in the sense of commercial world, in the sense of cyber insurance premium for commercial markets that will be actually shifted to personal lines, and eventually the regulations will make the insurance purchase a necessity. Okay, so here actually showing a screen of the typical provider cyber insurance. Okay, so, and here's why, as it's still largely undeveloped, the coverages were still broadening. We agree that this is pretty much undeveloped because, as you can imagine, 0.25% share of the total global non-life premium is really tiny. It's really still a small fraction of what would mainstream non-life product class of business would be like. So it is very difficult. Partly it's being undeveloped, partly the coverages were still broadening until last year, and it is very difficult to compare from one offering to another. But however, at the same time, as you can see, that the cyber threats are real and are increasing in both frequency and severity. We have, as you all can recall, we have a first wave of major events back in 2017 that triggered the awareness of the need of cyber insurance protection. We are still yet to see another major set of events since then. And the 2017, we're talking about NotPet here and WannaCry. And depending on how we define the 2017 set of events, which crippling many industry and triggering claims across mostly cyber cover extension related to property lines, I do believe there will be bigger and more damaging ones coming in the next few years. So no doubt we will see more growth on this sector, and the industry will be to look at the insurance policy, not just as a protection scheme. It will need to be served as a prevention scheme, taking care of the cyber security of their customers, providing 360 solutions, assessing cyber risk management, and as well as providing ongoing monitoring in order to ensure the customer are always ahead of the criminals behind all this cyber attack. So, as you can see, all these the fundamentals behind the cyber risk, you can see are quite extremely wide-ranging. We have threat actors such as here on this table you can see like organized crime syndicates, typically targeting data of financial value, such as personal credit cards, information, with a motive really to demand some sort of extortion or ransom in order, to make money. And so the consequence to that would be breach in privacy for the customers, and there also will be loss of revenue to the business. This is just as an example. So there are many more types of threat actors set out on the screen, which will lead to their motives with the asset being targeted, and all this will need insurance coverage to protect and to mitigate. Okay, and why? So as you all see now, the trends as to why cyber risks are increasing and evolving, we all know why. Firstly, you can see are related to the category of technology. We are more and more connected with not just the Internet of Things, but also the so-called Internet of Me. So we know that the Internet of Things is a system of interrelated computing devices, mechanical and digital machines, provided with unique identifiers and the ability to transfer data over a network without requiring human to human or human to computer interact. And there are actually these consumer connected devices, which include our day-to-day devices such as smart TVs, we have smart speakers, we have toys, we have wearables, we have smart appliances. And then for the commercial, we have smart meters, commercial security system, and smart city technology. These are all used to monitor traffic and weather conditions. They are all examples of the industrial and enterprise Internet of Things devices. And the Internet of Me is essentially a one-off network comprised of an individual set of principles, preferences, and location-based conveniences housed through customer segmentation databases and applied to a dynamic commercial model. This is essentially a personalization version of the Internet of Things. And with the rapid advancement of technologies, this will only become more and more common and then cheaper as well, and hence will create more first-party element of liability. And so, and also given the population and the GDP expected to grow still significantly and also exponentially, at least until the 2060s, before it peaks or plateaus. So you will only see more and more growth in terms of business numbers, and also the changing in the consumer behavior, and all this with the business culture changes as well. And then you will have the regulator to come in already with the GDPR, the CCPA, the Californian privacy law, and then you also have the regulator in the UK like PRA and Lloyd's, and also the European EIOPA as well as Singapore MAS to come in. So I mean, this will just drive all the increases in the demand in terms of insurance product, and hence I can just re-summarize the drivers of the increasing of cyber risk. We have strong increase in attacks on all kinds of targets across all industry sectors. And then we have the increase in the business interaction costs as a result of all these breaches. And then we have more regulation and more data protection requirements globally. And we have all this compulsory notification as part of data privacy law, and also other cyber damages are not really covered by traditional insurance policy. And you can see the threat timelines here. Essentially, we expect the cost of the global cyber losses is predicted to be around 6 trillion by 2021. And the security spending may exceed easily 1 trillion by 2021. And you can see the cybersecurity threats will continue to materialize and will evolve with attackers finding it even new way and more sophisticated ways to exploit their victims, to extort for ransom. And then you will also see that the cybersecurity and the insurance definitely will becoming more in demand increasingly, and also business will becoming more aware of the potential threats to their operation, hence the requirement in the insurance product. Here is a bit of the timelines as well in terms of the trends. So that we start with the attack in 2010s, and then it comes with the cyber insurance insurance offering, and then with the event in the notepad here, you can see also then the emergence of more and more cybersecurity requirements, and then we have the introduction of the GDPR, And then we have all the large fines, large scale fines we saw recently with Marriott and British Airways. And then also the increasing ransomware attacks in 2019, the high-tech, untargeted and targeted such as Ryuk, Maze, for instance, it's all becoming more syndicated. And then you subsequently will becoming more and more targeted, including the SME markets as well. Okay, and then some actual loss figures here you see with NotPetya. I just wanted to mention that it's about 3 billion loss, about 90% actually. I think 3 billion is the economic, and the 1 billion would be roughly the insurer, but actually 90% are actually coming from the traditional lines. Then you have all these recorded losses by the TCS in the US of losses of affirmative losses in excess of 20 million. A lot of the potential losses yet to be confirmed in terms of the loss cost to the insurance product, and then some of the already known market losses in the past. So what it leads to is our the increasing need of reinsurance capacity for the insurers because of the demand in the insurance, and also because of the systemic nature of the cyber risk. The insurer would really like to use reinsurance in order to help them to basically mitigate the kind of exposure in terms of the aggregations. So because of the need of the use of the reinsurance will actually help to address the mounting aggregation of risk. As we mentioned before, more and more devices becoming part of the IoT's ecosystem. There'll be increasing direct cyber insurance sales as a result, and there'll be a lot more growing concerns about escalating attritional losses as well. These are all summarizing the fear of the systemic or catastrophic loss despite profitable experience that we have seen in the past, and also the clarifying coverages under non-cyber traditional policy will only just push for more exposure to the cyber markets, cyber standalone market. And on top of that, we also need more and more the kind of sophisticated quantification methods. To help us to build this risk tolerance, to develop the views of risk, and to inform more in terms of how we should structure the reinsurance. And finally, it's also in terms of the increase of the awareness of the cat loading because of the uncertainties around the systemic nature of this single point of failure, and how we should model them more appropriately. All this will lead to a combination of our reinsurance requirement in the form of quota share, as well as adequate stop loss, and it's in order to help the insurance sector to continue growing. So here is an example of type of reinsurance being purchased recently, and the share of the type of structure being used to transfer the aggregation of risk for the reinsurers on the insurance products. And then for today, we also observe that the global insurers are actually placing more and more group covers, partly because you know that cyber risk is borderless, whether you're a group entity with locations in US, Japan, Europe, or APAC. Markets like that we're all selling cyber insurance policy together to different entities and the prices, but they might have one commonality. They could easily be affected by the same event, such as recently the mentioned NotPetya in 2017. And then there are actually increasing sessions to all these so-called cap market. The cap market basically because everyone wants to limit their exposure so that they know what is the maximum. So there's this annual aggregate limit being in place and becoming more commonly in place. Before that, a lot of the QS that used to sit risk away to the reinsurer tend to be uncapped. And also in terms of the incentives because of the profitability being eroded due to the increase in the number of claims as well as the average cost of claims. So even the products such as the reinsurance structure are related to the overriders to offset the expenses has also been reducing, and also the increasing cyber exposure now. We're also seeing that a lot more being tucked in within this composite casualty program. This use actually used to be very incidental as part of a cyber proportion of the sitting together with the casualty family and now becoming more and more sizable due to the growth in the underlying primary market. And also used to be third party liability being included now commonly first party, which is the one that you see the most losses of due to mostly business interruption. And also more and more new cyber element being added to the traditional casualty program of the carrier that used to be not offering any cyber as an insurance product, and now they are doing so. So all these increasing demands are opening up to more markets. Also, there's some used to be white labeling exclusivity, and then basically on top of that, still there's pretty much little change still when we talk about model, because in terms of accumulation, there's still no one consistency or widely accepted in terms of the use of a model to work out what would be the 1 in 200 event and 1 in 250 event, for instance. So as a result of that, because of all this uncertainty, it comes with still the capacity crunch, because a lot of reinsurers are equally conscious about their capacity constraint, also in terms of exposure, that they have to limit because of the understanding about what is systemic. So therefore, insurer will still struggle in order to be able to sit the risk away in order to adhere to their own internal group risk appetite, for instance. So here are the proportion that you see being seen in the market recently observed in the London market. And why there are challenges in the reinsurance capacity is mainly because they are just simply not growing as fast as the primary market. The challenges are mainly because of, as I think is well known to all, in terms of the data and the quality of the exposure information, because we have no certainty or clarity about what kind of exposure are being limit are being provided with, and also in terms of how to access to have this timely information, so that when there's an event, a bit like NatCat, we are able to pinpoint exactly how much exposure we have. Also in terms of cyber risk model and credibility, today it is a dynamic risk driver of aggregation for cyber risk, and it's also complex and anthropogenic. It's ever evolving. So it doesn't help when it comes to pricing, because we don't know how to properly quantify for it, which will hinder the kind of like long-term growth as a result. So here's the typical reinsurers in the market that we know that are having such a reinsurance offering at the moment. Okay, and then so hence why we also need retro and IRS in order to take away the reinsurance capacity constraint. So once the reinsurer are able to pass on more risk, then there will be more reinsurers able to accept more risk from the insurer, and hence the insurer are able to write more insurance as cyber insurance as a result. So you can see the demand for cyber capacity across all value chain has definitely increased. Key markets are looking to purchase retro to help them to manage the net position better, and also to support the rapid growth of the insurance market. And there will be continued interest in exploring some solution, like the first cyber industry loss warranty or IRS solutions. So there's some new one definitely coming, and we definitely need more in-depth understanding of cyber risk through this vendor modeling in order to help us to understand better. So here are some of the existing IRS provider. A lot of these are traditional ones that are venturing into or looking into cyber risk as an offering. So I wanted to touch on the COVID-19 quickly. Effectively, with the COVID-19, there are press reports saying the bad actors are taking advantage of the COVID-19 pandemic, and hence there are increase in the ransomware attacks. However, basically the ransomware attacks is not new. Actually, has been already we saw the picking the frequency pickup in 2019 already, and we only can confirm that it's actually, instead of using other way to fish information, they're using this hot topic pandemic as a way to actually try to penetrate into people's system or networks instead. Yeah. But what it means in terms of insurer, we're seeing more and more limits being reduced for sectors are especially affected by this pandemic, including hospitality, travel, retail, and also healthcare. And also we are seeing a lot more slowing down in the income because there's a lot of delay in launching new dedicated platforms. However, we are still seeing the submission rate is still very high. And so here you're seeing that there's still no sign in increased loss ratio being picked up due to pandemic. Um, so maybe it's a case of whether it's true that it's actually quite independent from this COVID-19 impact, or maybe it's a case that there are already a lot of ransomware lurking behind the system, the networks. I was just waiting for the economy to recover. That's where they are able to make the most money when the revenue is basically restored. And then the trend of we're seeing here is also because of the COVID-19 and more people working from home, working remotely. So there are actually a lot more questions around the cybersecurity, business continuity plans, and how they are tackling it. So in other words, if during the renewal or the new business, the insurers will tend to either reduce the limit if they are not able to be having a satisfactory response about how the company or business are going to be able to mitigate the exposure due to working remotely, or they will actually move away from all these high frequency layer losses policy, for instance. So I'm going to pass it to Paul for the next slide.
Thank you, Zeliang. Let me just share my screen. Okay. Good afternoon, everyone. Now taking on from Zeliang, let me talk to you about cyber insurance linked securities. Okay, now I would like to talk to you about the feasibility of having a cyber ILS as a possibility for the insurance industry. So I believe that this is not really a very new topic, but it's relatively current because the development is still in stages. Let me just briefly recap what is a cyber ILS, okay, insurance linked security. We are basically referring to a financial structure that is a bond which has cyber exposures as its underlying. Should there be a cyber event causing a loss above a trigger point, then the notional portion of that investment will be used to finance that loss, basically. Okay, according to some layers or some defined conditions. So this is actually very similar to how a CAT bond works, catastrophe bond works, which many of us are familiar with, where a higher yield is paid to the investor in exchange for the risk that is undertaken in line with the risk profile. Studies have shown that the potential protection gap for cyber is actually quite big, and is, as what you've seen in Zeliang's earlier slides, is going to be a lot bigger in about 10 years' time. And these studies have shown that the level of capacity that is available in the insurance market is not sufficient alone to support this protection gap. So therefore, a combined hybrid approach between insurance and capital markets eventually is necessary. And the cyber ILS is one way to make this happen. Okay, and of course, all of us know that this will not happen by itself. I mean, nobody is just going to go to the cyber ILS market and ignore the insurance market. Basically, the development of cyber ILS solutions has to progress in line with the insurance sector in the sense that insurance will only invest up to the same level of comfort as it is seen in the insurance and reinsurance sector. So if we are comfortable, if the insurance and reinsurance sector is comfortable up to insure a certain part of this cyber risk, then the regular investors, they will follow up to that. Because to me, I don't think an investor will invest even more than what the reinsurance sector is actually reinsuring or protecting up to. Okay, So first of all, let me go through some of the key challenges that you can see here that are featuring in cyber risk. So obviously, this is not an exhaustive list of challenges. A lot of ongoing research worldwide is happening within the industry and also with agencies like the CSA and with other broader cyber-related agencies. Nevertheless, these are very unique features within the cyber risk area that make investing in a cyber RLS very interesting, because depending on how the terms and conditions and how we understand the nature of these cyber risks and how we address them, it can actually enable a very attractive packaging of the cyber RLS solution. Okay, so of course, the key point to understand is that cyber is very unique in the sense it is very global, and any underlying causes that give rise to claims actually can be very systemic, in the sense that it can be due to a system flaw that is exploited by hackers, and it transcends all geographical boundaries. So therefore, it is very local and it can be very global depending on what has been exploited, and it can be very pinpointed in that sense. Also, the issue of claim behavior is something that is very new to the insurance industry, in a sense that because the underlying risk of the underlying losses that happen in the cyber portfolio are not independent, are not entirely independent, and do not follow what we call a Poisson process. So we need to understand this in more detail to model the dependencies between the cyber claims and make sure that we are able to understand the frequency and the severities. Okay, one more issue that is not mentioned actually is this issue of silent cyber. Silent cyber to IRS actually needs to be clearly defined, and to me, with having a parametric sort of approach, as you will see in my later slides, because of the clear definition, we can actually avoid the problem of silent cyber, because everything is very clear and there is no spillover from any unknown accumulations. However, I have got a lot of feedback that if in any case the trigger points are still very ambiguous, silent cyber can still cause erosion of the notional capital. So it's something to actually evaluate and to make clarity on in regards to ILS. Okay, let me move on to the next slide to discuss a little bit more on some of the features of parametric covers. So the basic idea of a parametric cover is that you have a way to link the insured, the cyber risk portfolio, with the provider, the reinsurer. And this is done through, usually it's an index or a way to define that feature, okay, to have a non-indemnity based systematic way to identify when a claim is being made. So generally speaking, a parametric cover can be linked to, let's say, a situation where you have a number of hours electricity, when a reading on a certain for a certain country drops below a certain point due to electricity failure, or where something like a number of hackers, when the index reflecting the number of hacks has hit a certain point, then the parametric trigger is activated. Of course, this is still a lot of research is still going on, and there is a very wide range of interpretations of how parametric covers can be structured. And it's actually something that we should actually look at collectively as an actual community. Okay, so in a more specific sense, we have here several ways to structure the ILS downstream. So of course, these are all very specific features that are actually reflective of the account, the specific ILS account. So I mean, some of these features are actually very common to the reinsurance treaty structure. So it's actually a way to improve and to actually control the overall profitability of the ILS. Okay, like having a variable attachment point, where depending on the model exposures, you select the attachment point accordingly, similar to the loss ratio caps, and also profit commissions where there's expected value. So all these can be done through the appropriate level of modeling. The real interest, the real need is actually to have a very good modeling, cyber modeling approach, whereby you can get a good PML and estimation of the underlying exposures, whereby you can apply all these features, loss participation clauses, and you can actually look at how it will be over a few years and how you can change the sessions to achieve the target yield for the structure. So this is very important to communicate to sponsors, and also to share this in a transparent way with the investors in the cyber ILS, so that they know how the ILS will behave, okay, given the loss structure. Okay, so in summary, with the help of all these features, it enables a closer step to actually bridging the gap from something that is very far out into something that is very practical and something that can feasibly be implemented as a realistic ILS structure. Okay, now ILS is actually something that is very specific to the investors. Let me just give you a very quick summary of what are the key requirements for ILS, a cyber ILS investor versus a sponsor. So generally, these were all co-aligned. The key thing for a cyber investor is that the yield, the returns has to be sufficiently high given the time horizon and the underlying interpretation of the risk and the trigger points of the of when the cyber will be triggered. Okay, the parametric cover will be triggered. So definitely it has to be above a government bond, and it has to be sufficient such that maybe after 5-year payback or something like that. Okay, another consideration is there has to be sufficient liquidity, and also the expenses and settlement transparency must be there. And of course, not forgetting the coverage must be very clear, so that the investor is very upfront and they know exactly what they're getting into, trigger points, and what will cause the cyber event to be defined as a loss to the notional amount. For sponsors, it's very simple. One key requirement is a very good cyber risk modeling process must be in place, and also, of course, the pricing in terms of the overall cash flows must be very good and reflect almost similarly priced risks on the insurance portfolio. Okay, let me just talk about some cyber developments. We've talked about cyber ILS that is in general for a specific account, but at an industry level, we could also be looking at industry loss warranties. Industry loss warranties are basically something similar but applied at a very big level across multiple clients and also even at a government level. But they generally behave the same in that you need a common parametric index and definition to trigger the loss to be paid. This is good in the early stages of when the industry is forming up in the formative years, when the commitment needed is very low for each of the participants, but collectively it does give a certain level of substantial support to the industry. Of course, a lot of research will need to be done on whether it's on the trigger and the nature of the index, and of course it can be defined to be a per occurrence, one single event, or whether it can be aggregate over a certain time horizon, 1 year, for instance. The root is that you will need, similar to ILS, a very good cyber risk modeling process must be done to estimate the probable maximum loss, the PMLs, at the various levels, considering whether it's DDoS, whatever is the underlying cyber attacks are being considered. Okay, so this is the thing to talk about. Just to recap, the cyber risk working group, the SAS emerging work stream is involved in all these areas. We have been starting on cyber risk awareness for a few years already, and we will seek to look at developing the link between research, the industry and also the regulator to try to support the SAS community, actual community on further strengthening cyber understanding of cyber, and also to look at how we can move into cyber ILS or reinsurance as and when it's ready. Benchmarking and market studies, pricing to improve the understanding of cyber pricing, reserving, and accumulation best practices. These are also areas that we all have to work together as actuaries in this new normal as well. Okay, so just some concluding thoughts on this slide so far. We can't run away from the fact that cyber is more becoming a peak purview in a new normal. With digitization and all these trends. So it is something that will eventually drive the volatility of our earnings, insurance side and also for corporate side. And we definitely need to address this. Cyber ILS is definitely one way, in a hybrid way or with the various stakeholders to provide good covers to meet the protection gap, the rising protection gap that is coming up. Of course, to get to a good cyber ILS solution, we need to have the correct level of awareness, and we need to have a good risk modeling process and good understanding of the various vendor models that are currently out there in the market. Okay, so how can we enable the growth of cyber insurance market collectively? We have as reference points various regimes from the UK, Bermuda, and London as well. So those are more mature markets that we should be looking at to study. And we should also ask ourselves where are the key areas that we can take action ourselves to improve on cyber insurance in the next few years. Okay, so these are just the members that we have on the IFOA and the SAS Emerging Group work stream here. Feel free to approach any of us. We'll be organizing a few more sessions, more in depth on cyber risk modeling or any other areas as well. Okay, so this is it. Thank you very much. Let's move on to the panel discussion.
Okay, thank you, Paul and Siliang, for the presentation. And thank you to everyone for listening in. We have about 10 to 12 minutes remaining. So we will begin our panel discussion shortly. I will start the poll questions second set. And please take a moment to answer, and I'll share the results of the first set and the second set shortly after. Okay. Yep. So, okay. So let me start. Okay. Another reminder, do keep the Q&A questions coming, and so we can get that discussed during the panel discussion as well. Okay. So welcome Linda, Paul, and Siliang again to the panel discussion. In your presentation, there are a lot of discussion in the market about cyber risk, cyber cover, etc. Linda, maybe do you think you can talk us through some of the activities you have seen so far on cyber and how that has progressed in the last few years?
Yeah, thank you, Jennifer. Yeah, I think that's mostly already mentioned by Siliang. There is heightened awareness of cyber breaches among everybody now, among many companies. So we see more interest in buying such products. Take-up rate for standalone cyber coverages have also increased over the years. Based on two reasons. One, also mentioned that insurers are trying to limit the amount of silent cyber exposure and pushing the insured towards more standalone cyber covers. At the same time, insureds are also realizing that, in order not to let other risk eat into their aggregate coverage limits, it is actually better for them to buy a specific cyber coverage. On the side of insurers, we see more and more insurers going into the cyber line. Product coverages seen across the board is still not totally homogeneous. We see different insurers offering different elements in the normal cyber cover, or at least they have varying different sublimits, how much exposure they want in each element. There are also big differences in premiums that's seen across the board, particularly in the US. So yeah, I mean, in terms of standardization of the product itself, this is still work in progress. There's you know, a lot that we need to work on. We need to work on the standards, the product structure itself, underwriting in terms of wording, how do we deal with the claims handling, and of course, pricing itself. As far as we can see currently in the market, I think most of the pricing is still being based on what we call traditional pricing methods. Yeah, that's
Okay.
how I
All
see
right. Okay. Yeah. So I know you are working in the area on pricing for MS Cyber Risk Management project. What are the main difficulties and issues you encounter in the pricing of cyber?
Predominantly is the lack of data. So
Yeah, true.
I mean, we
Yeah.
all know new product, no? So there's not a lot of claims history compared to other traditional insurance. Even if you consider more mature markets like the US, you can see from their ISO rate filings where they could come up with very sophisticated rating tables and different rating factors. But there is actually not a lot of claims data behind all of that. So a lot of the pricing is still based on a lot of benchmarking and a lot of assumptions in place. One of the difficult area would be estimation of frequency. So we know that it's an evolving risk. It's the frequency is increasing over time. The type of cyber attacks are evolving. So what we are used to, the kind of retrospective approaches to estimating severity and frequency has to change. So we have to move our pricing to be more dynamic in able to capture that, to make sure that, you know, we are adequately priced. I mean, on top of that, I think one of the biggest challenge is as mentioned also, the assessment of accumulation risk. So we have seen many academic papers suggesting different ways of modeling accumulation risk, and some also like likening, you know, it to the spread of a pandemic virus, for example. I believe it is not something that can be tackled entirely by the insurance industry by itself. We need support and a lot of collaboration with external vendors to get more information on cyber attacks as a whole before we even talk about, you know, insurance claims.
Okay, thank you. Moving on, in terms of the data that you mentioned in the, I think, Siliang, what is your view on the data readily available for cyber, and how do you see the aspects across various regions, for example, Europe compared to Asia?
Thanks, Jen. On the data front, we actually have seen a lot more improvements. In fact, in terms of the standardization of putting data together, there's some initiatives going on at the moment, definitely within the Geneva Association, partnering with one of the leading reinsurer. I mean, it's Munich Re actually, in terms of setting this CYDR, the so-called CYDR, which is more like cyber incident reporting, some sort of repository database in order to help insurers and reinsurers to notify or to set up a database that will have all the information about all the cyber incidents. Well, this is in a very early stage. The committee are still getting the support, drumming up the support from all the reinsurers and insurers in order to participate together to provide some funding in order to set this up. So this is still a very early day at the moment. In terms of other initiatives, we have, let's say in the UK, International Underwriting Association, already putting together a template about the sort of data a typical insurer would need, so that we are able to capture all the information more correctly in terms of exposure information, in terms of coverages. It's actually no different from the traditional sense of the product. However, because of the offering being so different from one provider to another, I mean, not very different in the sense that it is different because you have all these more different extensions or coverages. So it is important to have some sort of data template to help capture all this information. So when it comes to accumulation and when it comes to assessing the information going forward, there should be a future-proof kind of database ready for use in the sense of when it comes to rating, come to benchmarking exercise, etc., etc.
Okay, thank you. So let me share the polling results on the first set so we can have a look at what's the response. Okay, so it's open to the panel. So how much are you involved in cyber reinsurance as an actuary? We can see the level of responsibility is not high yet. What are the areas you are involved in? Will be more on interest for now. Let me go to the second set of the polling results. Okay, so these are maybe how do you see cyber insurance products being sold as? So we have a variety of response. Maybe I open this up to the panel if anyone wants to comment on what's your view on how you see the cyber insurance products being sold in the current and in the next few years, maybe.
Yes, I agree that it has to be sold as a service. Definitely not simply a risk transfer option, because firstly the knowledge, people's knowledge has to be satisfied as well. So the service is very important. So that's where companies who are able to offer that part will definitely stand out over above just simply risk transfer. And there's a lot of clarity that needs to be done as well. What the terms mean? What happens if that happens? If there's a hacking or how? Yeah. So this also must be clarified as part of service. In response to the question by on the e-wallet, so that also links to the how a service can actually help in quantifying and also in this case is a digital assets, right? So that also is a separate topic, how it can be valued as well. So this is something that has to be addressed holistically to me. Yeah. Anyone else want to reply that?
Thank you, Paul. In your area of work that in your presentation early on, we can see that ILS can help to carve out and provide opportunities in terms of quantifying the mitigation and the risk transfer solution. Do you see the expansion of parametric insurance as the way forward for cyber?
Quick answer is yes. It seems that way because it's clean. One way is that you can just define something, trigger point, and then if it's hit, then the payout or it's a non-indemnity based kind of solution. So that can be a good way that cuts through a lot of the that is avoids the problems of having an indemnity based approach. However, identifying and understanding that trigger point and what are the ways to verify that trigger and make sure there's no fraud or what, that is the key as well. That will introduce other challenges. So all this has to be addressed together.
Yeah, I mean, in a nutshell, you need an independent sort of like sponsor to be able to verify when there's a trigger, and that verifier should be able to then justify, well, the trigger is genuine, and then that's where payoff can be made. It's a case of having that independence kind of like agent and sponsor in place in order to have this happen. So at the moment, the closest one that we do know of, I mean, in terms of the IIS index that are trying to be developed within the PCS framework is coming up with cyber index solution, but it's still very early day again. Yeah.
Okay, thank you. I think we have 1 minute left. So last and final words from each of you, maybe in terms of how would you see the risk landscape evolving for cyber and what are the potential of this risk embracing in the ILS space? Open up to the panel.
Well, I think it's in terms of, both ILS and parametric cover, it's still really early to tell whether it would be the solution going forward. There are many hurdles that are still to be, cleared before we talk about, ILS, right? ILS as itself is not an efficient use of capacity if we talk about bond, because you have to hold up the 100% of the capacity instead of only a certain percentage of risk capital that we need to put up if it's in a form of insurance. The other point is the attractiveness of ILS to investors. Well, for it to be attractive, it has to be balanced, whether it is still affordable to the insureds. And then we have to talk about whether do we want to offload tail risk versus attritional losses. And if it is tail risk, then maybe the yield might not be interesting to the investors. And as per parametric covers, of course, it was mentioned before that, you have the problem of finding the right trigger to cater to the basis risk of the complex cyber products as a whole. There's different elements in there. There is first party risk, third party risk, business interruption. How do we, take care of all that into one single trigger? So, in my opinion, I think the ILS or the capital market investing could be a possible way forward. But first, the insurance industry has to find a solution to a more robust pricing and a more viable product for it to be interesting for the capital market.
Okay, thank you. So in that we are 2 minutes overrun. But I'll thank to the panelists for taking on the session. I hope the session is also useful for them as well for everyone. Thank you all. And on that note, I will like to end the session today. And I hope all of you have a good time. Thank you. Bye-bye.
Thank you.
Thank you. Bye.